Hey everybody, it's Will here. Welcome back to another episode of the Blockware Intelligence Podcast. Today we have a very special guest, my buddy Steve from Sats Capital. Steve is somebody I met through Telegram. We've gotten relatively close. Also, he's on Twitter, but we got to know each other through Telegram and through some different trading groups. So, Steve, I'm really happy to finally have you on the show, and I'm sure the audience is going to get a lot out of what you have to say today. Thanks for coming on.
Yeah, thanks for having me.
I think we can first start with maybe for anybody who doesn't know, kind of who are you and how did you get into the space? What do you do now?
Yeah, so I probably didn't have the typical start. I guess a lot of people you talk with now. I don't really have like a traditional Wall Street background or anything like that. I actually started off. Well, I'm an engineer, I guess by trade. That's where I went to school for. But I've been into crypto for a long time now. Since started in 2013, April 2013. So my dad was kind of a gold bug, so he kind of got me into some investing late 2012, and then I started kind of researching more and more, and then I ended up hearing about Bitcoin from Max Kaiser because I used to watch RT a little bit back then, and then so I got into Bitcoin right as this Cyprus stuff was going on. I'm not sure if you've heard of that, but basically like they had bail-ins in Cyprus where they took money from people's accounts and essentially gave them a haircut. So that was kind of the times when I started getting in there. And then I basically put a small amount in to begin with, and then I was working over in Taiwan for a while in mid 2013. And I started to just research more and more, and I kind of got the use case more of what was going on with Bitcoin. And then I basically started stacking back then, and then I rode it all the way up to the bubble in late 2013, and then I rode it all the way back down because I knew nothing about trading. And I was like, all right, I need to start understanding how this stuff works. Why is the chart moving the way it does? So I started getting interested in trading like right after that in 2014. So.
What was it like in the early days with, I'm guessing like the community of traders was like super small, super niche. So kind of like talk to us about what was that like back then? Was there even like a crypto Twitter or?
Yeah, so I kind of started, I had a Twitter account. I made a different one because I found some people that were talking about crypto. You know how you can just use this search bar on Twitter. I just basically was searching Bitcoin, see what popped up. And then there were some people that were trading back then. Probably the only people you might recognize now were Kobe, Crypto Cobain, and then Jeebus was around back then, and then some other guys. But yeah, like I just kind of followed those guys and tried to learn some things. And then I just started, Chris Dunn was another guy that I kind of learned from back then. He's still around. But yeah, just like going through charts and trying to figure out, I feel like I was the same as everybody else where I start with, all the MACD and, all those things, which I still use a little bit, but, I've just enhanced my trading probably, 10x since then. But, everybody has to kind of go through their start and see what works and doesn't work. So that was kind of a little bit of my process. I started getting more serious about trading, I guess, where I was tracking all my trades in 2014. I started trading on Bitfinex. And then, because you could do margin trading back then. And I mean, this is probably when price was 200 to 400 range or so. So started getting interested back then. And then, yeah, so kind of fast forward a little bit, I continued to be real interested in crypto and stuff. And yeah, I had a little scare with the Bitfinex hack in 2016. But luckily I got pretty good chunk of my stack back, and it wasn't the only exchange I used. But then I started getting more serious about keeping stuff offline and hard wallets and whatnot.
Were you expecting the hackers to be the people that they turned out to be this year?
No, that whole thing was pretty wild. I mean, with crypto, like there's never a boring day ever. I mean, every day is just something insane that happens. And so, yeah, you look at that one girl's Instagram and it's just like, what is going on? I mean, who knows? I think the guy might've been the brains, but who really even knows? I mean, and yeah, that whole thing was kind of wild back then. but I was able to survive that, which was good. I mean, and that's really what a lot of it is in crypto, is just surviving. I mean, if you survive and you avoided the exchange hacks. I mean, you have to remember, like back then, there wasn't anywhere near the level of sophistication of security that these exchanges have now. I mean, I feel like there was almost a major hack like every other week, or not every other week, but every other month. And so if you could avoid those before they started making hardware wallets, like that was a really big deal. So truly it was just survival. And then obviously we had the big run in 2017, which was fun, and alts and everything. And then I was still working back then though. I wasn't doing full-time trading. So but I decided after the run in 2017, I had enough saved up and everything. And I was good enough trader where I was going to go full-time. So I started going full-time. I quit my job, my engineering job, in August of 2018. And it was kind of nice because that was in the bear market. So it's not like I was, one of those people that quit at the top, and thinking that they were a genius. Like I'd been through the cycles. I knew what was going on, and I kind of wanted to make the leap. And then kind of fast forward from there, I became pretty good friends with a couple guys, just in Telegram groups or whatever. And then one of the guys reached out to me and said, "Hey, I'm thinking about starting a hedge fund. Like, I want you to meet with me and my buddy and potentially be a lead trader for us." So I met with them late 2019, and then hit it off with them. And so then then started working for SatsCap as a trader. One of the partners left the end of 2020, and so I came in and started, and now I'm a partner there with Trey. So
It's one thing you had touched on, which I kind of want to dive into a little bit deeper, is the fact that you've been in the market so long that you kind of knew what was going on in 2017 when, not we, because I wasn't around back then, but when Bitcoin was kind of reaching that, euphoric stage towards the latter half of 2017. Can we just walk through for listeners, because I'm sure there's a fair amount listening that maybe got into Bitcoin and just crypto overall in the last year or so. Can you kind of talk through the psychology that you've learned to recognize through both the bull and bear markets? Because I personally got into the space in late 2020, so I personally haven't experienced a deep 80% correction. So kind of walk through for myself as well as the listeners, how to kind of navigate those emotions and those broader kind of swings, and what is it like down there in the depths of the bear market?
Well, it's not a whole lot of fun. I'll tell you that, but at the same time, they're a lot easier now because, now crypto isn't going anywhere. I mean, back then when I first started investing, I truly thought it was binary. I thought like either Bitcoin was going to something crazy like $1 million, or it was going to zero. Like there was only two options for me, kind of. And so that's like why I hold on to a lot of those coins from back then, because I was just kind of a believer, but also I knew that the possibilities of losing it too. But so the bull markets, it was pretty easy to identify the euphoria in late 2017, and I was pretty into charting then as well. So I kind of realized that essentially like a way to identify a parabola. So on the weekly chart, you basically have various accelerations. So you can draw a line, and then basically like you can check out the angle of that line, and then you do it again. And I think there was 4 or 5 different accelerations, and then basically when the last one breaks, that's when like the bubble's done. So I was pretty bullish like all the way up into 2017, and then basically after that drop from 20K to 10K, and the subsequent bounce, I turned pretty bearish. I ended up selling like a pretty decent amount of my stack, around I think 17K on the dead cat there, just because I had seen this before. Like luckily I'd been through 2 bubbles, so the early 2013 and then the late 2013 bubble, where I'd seen these things play out. And I'd use OTE, so I'm not sure how familiar you are with that, like the Fibonacci's. So Fibonacci lines, like basically between the 61 and 78 fib, is normally a really good retracement area, especially if you have a parabola that breaks. So I was kind of eyeing that area, and that's how I kind of knew like if we can't get above this, like this is probably done. And then I was able to kind of write it down. And I bought back between 3K and 8K, I believe. So,
Steve, what are some of like the craziest moments in the time that you've been in the market? I'm sure, COVID was one of them. You talked about the Bitfinex hack. Talk about some of those big moments. And was there ever a time where you thought maybe this thing was actually going to go to zero?
Mount Gox was definitely like a pretty shady. I remember Ryan Selkis at the time was kind of the guy that broke that news. 2-bit idiot is his Twitter handle. And that whole thing was insane, like just how they didn't have any of the Bitcoin that they said they had. And then, I mean, at this point, like, governments we know could have killed Bitcoin if they wanted to, probably, or, pretty severely dampened it. They just didn't care because it was too little. But yeah, no one knew after that point if it would catch on, like if people would trust it again. It took a long bear, a lot of sideways, back in 2015. Yeah, the Phoenix hack was pretty crazy.
Didn't price go down like 80% or something after that? 90%?
Yeah, so 2013 after the I think the peak was 1200, went down to 160, I believe, and hit that twice. And then also in 2017 went from 2000 to 20,000 to 3,000 roughly. Yeah, so both those were like 85% corrections. I was pretty confident in 2017 that it would be fine and it would come back because there was just so much more investment that was pouring in, and like Wall Street started getting kind of involved, like you started getting these exchanges, like bigger players. And so I think I knew at that point, like I wasn't really too worried about it. It was just basically like managing risk throughout the bear and, like I said, surviving it, and then knowing where this could potentially go in the next 5, 10, 20 years. So
how do you navigate the bottom? Like, I'm not assuming you or many people, call the absolute pico bottom, but at what point do you start to say, okay, this thing's probably starting to turn around. It's probably starting to find some footing. There's certain metrics or just kind of sentiment stuff, or like, what do you look for?
So yeah, like really like metrics weren't even a big deal or like a thing until really like the last couple of years. So even in like the 2018 bear market, the bottom 3K, I would mostly just use TA on technical analysis and really like higher highs and higher lows. Like throughout 2018, there was like that huge descending triangle that just had, it was similar lows, but it was like lower highs every time. And, and when that happened, eventually like the bottom broke out, people just panicked. And then you got your bottom went down to 6K to 3K. But then we had like higher highs starting to build in that range all the way up until April. And then you kind of had that crazy candle from, it was 4K to 5,500. And then everybody thought because 6K had been tested so many times that wouldn't be able to break quickly, and people started shorting, and then people were in just complete disbelief. And that's when you got the run from 3K to 14K in a matter of months,
It's pretty much shorting paired with the plus token Ponzi, right?
Yeah, that played a role as well. Yeah, but funding was pretty negative all throughout then. So you could tell like people were shorting. And then, yeah, the plus token, like we found out that later, after like maybe a price was at 10K or something. And then we figured out they had like 200 to 300,000 BTC that needed to be unwound. And at the time, like the mining issuance, I think there was like 1,800 a day. I mean, so it was quite a bit even more than mining issuance, that needed to be sold off. And Huobi was kind of selling it off the Chinese government, I think. So that kind of helped chop price around in throughout 2019. And so.
So kind of like on a pivot, we talked about like psychology in a broader sense, but can we talk about just psychology of trading in general? What are some of the, biggest challenges you faced throughout your career? And like, how can people listening that maybe are new to trading improve on psychology in general when they're trading?
Yeah. I think the biggest thing is just like, I read Trading in the Zone. I'm not sure if you're familiar with that book, but it's a really good book to help manage kind of your emotions. And basically what I've found over the time is basically do the opposite, whatever you're feeling. Like if you're really fearful, chances are if you buy, like it's going to turn out fine. And if you're really, really feeling really greedy, then chances are like, if you take some off, like that might be a good time. So the crazy thing about markets is really like they take prey on your human emotions. Like say if you're out in the wild and you saw like a pack of wolves or something, well, your fight or flight response, your fear response is going to help you stay alive, right? Or in that instance, are you going to run? So but it's kind of the same emotions pop up. Like you see the huge red line on the chart, or a big dump, and then you get scared, like you get really fearful, like what if this is the end, and so what that's doing is like it's telling you to sell, really, out of fear. But those are the times you need to manage your emotions and really take hold of it and learn to understand what emotions you're having, and then really like almost trade against them. So I've been doing this so long, I don't really get too emotional. I'm pretty flatline. And I think that's just kind of like who I am as a person too. Like I'm pretty chill. I don't really get too high or too low, but so that helps me. But I know some people like really struggle with emotions, and when it comes to trading, and what I would say to them is just kind of do the opposite of whatever you're feeling, and definitely be cognizant of what you are feeling, and that can help you.
That makes a lot of sense. I kind of want to pivot to like your actual, individual like trading style. Can we first talk about like, kind of a high level of the fund? How's it structured, and like kind of what's the average time frame of the trades you're making, and just generally like how's the fund structured?
Yeah. So when we started this, it's basically like a long only fund. So we're really trying to get exposure for people that might have a bunch of like TradeFi investments and so on, and like they're looking to get a little bit of diversification to crypto, but also like high upside. So we're trying to outperform the market. We're basically trying to outperform Bitcoin. Like that's kind of our baseline. So yeah, we base out of that, and then before like we were following like the 4-year cycle and so on, but I mean, and I'll be honest, like I thought like price would get a little bit higher. And I think part of those reasons is probably due to, I think it was the China ban in the middle of last summer. I think we might have gone parabolic there, but that muted along with the Elon FUD. And then this time around, like back in the last December, I think it was the Fed essentially turning hawkish and, high inflation prints, like that kind of helped mute us a little bit. But that's not necessarily a bad thing, because this whole time is essentially like a big base. There's a saying out there, it says bigger the base, higher the space. So but yeah, I'll talk a little bit about my system and what we use.
Yeah, that was the next thing I kind of had written down to talk about. So if you want to go ahead and dive into that, just kind of however in depth you want to go.
Yeah, one more thing I'll say about the fund is so we try to use alts. Like alts are good, like a way to be able to find some basically some additional alpha. So we were in pretty heavy Ethereum basing on Ethereum almost for 2021, and now we're a lot heavier Bitcoin. But I mean, you can find a lot of basically gain additional BTC by looking at that. So we also do margin trading and options trading as well. So I just wanted to mention that before I.
And I guess one other thing as well, before you get into actual trading system, while we're kind of talking about the fund in general, like what is it like managing your own capital versus other people's capital, and what's like kind of the psychology that you have to kind of face?
So I've kind of made like almost 2 or 3 transitions in regards to the psychology with that, because so the first one I was just trading on the side, like it wasn't too big of a deal, because if I messed up with something or had a bad trade, like it was no big deal, because I still had my income from basically my job, my regular job. So that was way less pressure. And then I kind of transitioned to quitting that, and I was more reliant on my trading income. So that was a different psychological way to look at it. And then moving on to the fund, it's even completely different, because you're basically taking that additional emotional load from almost like the investors, because you want to do right by them, obviously. So and luckily, like I said, I have a pretty chill personality. I'm able to take that without getting too high or too low. And luckily, like it suits me very well for my job and being a trader and, managing risk and all this stuff. But honestly, like it is a big transition. It is a different transition. And so we're a pretty small fund, but we have me and my other guy that's a partner. And then we have basically like 2 employees, so 1 trader and then one the guy that does research for us. And, our trader just started pretty recently. He was kind of with us part-time, but now he just started full-time this Monday. But I told him, I said, it's a little bit different, trading for a fund. So like, if you ever, need any help or to deal with the emotions of it, I can help you because I've been through it. So.
Yeah, totally. And then if, now again, if you want to like kind of dive into your trading system, because I think you have a good, kind of broader look at several different aspects of analysis that the audience would definitely find.
Yeah. So one of the things like we kind of try to take a look at is, so momentum is one, value, which is basically like how far is the rubber band stretch, away from like it's moving, some of the moving averages that we look at. The other one that's been really important the last year or so is derivatives. And so those are like, I check all these things twice a week. So Mondays, normally we have a trading meeting, and then me and my, the other 2 employees will go through all these charts, and I'll kind of run through them with them. And then basically what we try to do is make sure that, our positioning is lined up with what the market's showing. Like basically taking a look at this objectively and saying, okay, all this is saying it's very bearish, but we're, max long and a margin long, like we should probably get out of that. So some of the things I look at, so I really like Heikin-Ashi candles, like with the MACD. So basically what that strategy is just like all the candles, if they're green and you get a MACD cross up, like that's going to be a bull. I also look at Stoch RSI. And so I used that for a long time, and that's kind of it's kind of tricky, honestly, but I've just used it for so long that I'm used to what signals it gives. And then the other thing I look at for momentum is SCMR. It's basically like a series of moving averages. It's just like kind of like a paid indicator type thing. So I basically look at all those on the 1 day, 3 day, and then like 2 week time frame. Obviously 1 day is going to be more responsive than the 2 week, but like 2 week will show you, are we in a serious uptrend? Are we in a serious downtrend? Because if the 2 weeks in a downtrend and the 1 day, turns bull, well, you still are kind of fighting the trend a little bit. So just something to keep in mind. And then, so in terms of value, I look at 1 day RSI, a 3 day RSI, Mayer multiple, which is basically just price divided by the 200-day moving average. I look at basically the price divided by the 20-week moving average, the price divided by the 50-week moving average, and then also the price divided by the 50-day moving average. I also check out GBTC premium. Is that turning up, down? What's going on with that? And then also like any bull or bear divs on mid time frame. And so what this value does is it allows me to kind of check out and see, how far is rubber band stretch. So say that the 200-day moving average is at, I think it's at around 50K right now. Well, if we're at 30K, that means it's at 0.6. So what I've done is I went basically gone back and I've run back testing with distributions to see throughout the price of Bitcoin, how often does that 0.6 happen, and it might happen 1% of the time. So if what that's telling me is, so even if momentum is bearish, but value is super far, in the wrong direction, what that can tell you is it's a really good time to buy, even though momentum is bearish. So I kind of look at all this stuff together, and you kind of see up here on the screen, like recently, Mayer multiple was at 0.5, that still only happens 23% of the time. And, the distance from the 20-week moving average was 0.78, like that only happened 13% of the time. So, and the other day when we were at around 35K, these were pretty low. And I also have some stuff like for the RSIs as well that aren't in there, but I think you understand kind of the gist.
I think from an on-chain perspective.
Yeah, I'll touch on that in a minute. And then I'll go through the derivatives and I'll kind of move on to that stuff. So derivatives, I basically look at funding, futures basis, which is like, futures curve, they annualize. That's what got super crazy back in early 2021, where it was paying
45%, I think. So
yeah, the cash and carry trade was 45% by basically doing nothing. And now it's down to like 2.25. So it's, to me, like that's pretty bullish because like the froth is completely gone. We look at premium, liquidations, open interest divided by market cap, long short ratio, liquidity. So that's kind of like some kingfishers. I have a proprietary liquidity thing that we use to kind of see where some 10x and 3x liquidations are, and I could probably show you that in a little bit. I'm also looking at like heat maps, and then I also look at like Phoenix margin, because that's where like the smart whales are, in my opinion, the OGs. So and I could probably show you this on the chart a little bit later, but just going through and looking at that, and you plot it against Bitcoin, I mean, really like the long shorts will move with it pretty well. So moving to, I guess, like so those are biweekly checks, and then my bi-monthly checks, we check top signal metrics. So this is a lot of different stuff. This has some on-chain stuff in there, like ASOPR, MVRV, pi cycle top, Pel multiple, all of this stuff. This is all basically free or with the glass node. We have a tier 2, but so I like to look at all that stuff, and like this is something we'll just do to make sure we're not close to the very, very top. So right now it's all kind of saying like there's value or it's bull. I also look at macro quite a bit, and that's one of our biggest things we look at now because it impacts everything. But so I look at with that, like, is the Fed dovish or hawkish? What is the quarterly GDP estimate coming up? What is PMI, FCI? Like those are both like economic health indicators, non-farm payroll, dev GDP, inflation, so on. So a lot of these metrics, and I'll probably go through those in a little bit too and show you kind of what I'm looking at or what my basis is. But then we have so sentiment, which is to look at fear, greed, podcast downloads, Google Trends, exchange followers daily, and then crypto Reddit subreddit. Those things just kind of show you like how frothy is it. Those are both on skew. And then I actually, it's kind of interesting. I look at some seasonality things, which is, so I had a buddy, I'm not sure, do you know DJ Thistle?
No.
He's kind of an OG. He's not around too much anymore, but like, so I actually kind of learned seasonality stuff from him. Basically, like equinox and solstice are normally pivots. Like if you actually go back and plot those versus the chart, like they oftentimes will become a pivot in the chart. Why? I don't really know. It just, it's one of those things. So I look at that, what's going on? Like, is it a positive month? Are taxes coming up because people have to sell for those? Like just stuff like that. And then, yeah, to answer your question, like I do look at metrics with daily demand metrics and then daily supply. So one of the things like I kind of missed back in, I guess it was December or November, is that, all the supply metrics looked great, but there was really not a lot of demand, and I think part of that squeeze up was derivative led. So there was a lot of people buying on leverage, and then there just wasn't a lot of sellers at the time, but you had people that were trying to sell in the 60Ks. So price ran into supply, and then obviously just couldn't sustain, and so it's all sold off. So some of the metrics I look for demand are active addresses, addresses with non-zero balance, miner revenue, which is essentially like the meme pool, and then 1K or above, and then 1 BTC, like are those trending up or down? Short-term holders, which, kind of show like if there's a lot more short-term holders, that means that demand has been coming in, and, they're buying up the coins from the people that have been holding for a long time, from the long-term holders. a couple other things, but yeah. And then on the supply side, like the liquid supply shock ratio, long-term holders, net position change, coin days destroyed, dormancy flow, 1 month realized cap hold waves, supply delta. So those are kind of some things I overall just check, like just to make sure we're on top of it. I still do a lot of like trading by feel. So in terms of like our trading allocations, like I will use 25% using the 3-day Heikin-Ashi strat. 50% is basically discretionary trading levels. And I kind of have like an allocation matrix for that, which it says like, say we're above, 41 or, then we're going to be so much in Bitcoin. And if we drop below that, like we're going to turn into so much cash and so on. And they also have proprietary system that uses a scoring system for contrarian, and then proprietary system that uses momentum based stuff. And I kind of have scores for that. And that's like a smaller percentage. But yeah, as you can see, like 50% of our trading is, like kind of discretionary, just like feel almost. Because like, for example, recently, we broke 40K and we went into some cash or basically hedged on that break a while back, because I thought that, there's quite a bit of stops under there. But, we held 33 there. And so we bought a lot of that back around 33, 34. And then, so we went up to 46 and then we went back down again recently with the dip. But I kind of thought like this time there wouldn't be as many sellers, because there wasn't as much leverage that needed to be taken out. And then, also like all those high beta traders from Wall Street and so on that treat BTC that way. I think, I just didn't think it would fall as much, and I was right. We went down to 30, I think 36 or 34, and that was with the day of the invasion. So, and then the last thing we do is like we kind of have a high beta play. So I use the momentum strategy for alts, some of the bigger alts like Ethereum, like Luna, AVAX, Sol, like some of those. And basically, like when the momentum is positive, we might be heavier in those to try to get make some more Bitcoin out of it when the alts are doing well. Which right now I'm not really like super high on alts, but then we have a couple of speculative alt plays. So,
what do you think about? First of all, that was super insightful. What do you think about the potential of kind of a Bitcoin-led rally here, at least kind of a liquidity flow back to Bitcoin in the kind of short to intermediate term?
Yeah, I'm a pretty big proponent of that, actually. Like, so I think there's a couple of reasons why alts did well last year. So obviously, like Bitcoin has kind of been sideways for a year or so, and then like basically all the alts almost did pretty good last year in 2021. Including Ethereum. But I tend to think that Bitcoin, people kind of forget about it. It's kind of like a sleeping giant. I call it the king. But it's like don't sleep on the king, because they'll creep up on you. But basically, yeah, I think late 2020, a lot of people were pretty heavy in alts, and then you saw Bitcoin just completely suck the air out of the room and was going up, and people dumped their alt positions at a loss to chase Bitcoin. They're basically trying to chase whatever's going up, and also, so you had a lot of outside capital coming into it. It kind of created this vacuum in a sense towards Bitcoin. But what happens is when that's going up, basically you need Bitcoin to go up to draw more liquidity in from the outside, get more people interested. And when that happens, money flows down to other alts. And Ethereum, I think it kind of liquidity flows downhill. And you definitely saw that. Like you saw Ethereum pump, and then you started seeing like the shit coins pump, like the Doge pump and some of those things, Shiba, and I don't know. And so I think there was a couple things that went into that last year. One was all the fiscal stimulus. So basically the Fed was, very accommodative with money policy. And so you had people giving stimulus checks. They didn't have to pay their rent in some instances, like they're getting child tax credits. So they just had overall more discretionary spending. And think about it this way: if you get a check in the mail for $1,000 and you'd actually don't need that money, well, you basically look at it as free money, right? Which it is. in a sense, but I think you saw people like hey, I got $1,000 check. I'm just going to go gamble this check, and bet on Doge or whatever. Like, and I think that's the reason why you saw a lot of that. You're also seeing a lot of options tick up in the last couple of years. And I think that's kind of a similar thing. And that kind of goes all the way back to like, this tends to happen over history when money is failing. And so I think like fiat money is failing, and that's a reason why you're getting a lot of the speculation and stuff. So
it makes a lot of sense. I kind of want to pivot a little bit from, you kind of gave what kind of constructs your view of the market. And with that in mind, what is your current view on current market conditions?
Yeah, let me pull up some charts, I guess, here. BLX. So overall, generally, if you go out to like the weekly, so you kind of see these patterns that occur over time. And here, let me pull up a chart, the monthly chart. So I made this a while ago or posted on Twitter, but basically what it's showing is like you see these patterns that develop over time. And this is actually the longest like sideways consolidation pattern that we've seen. And I posted this a while back. So I mean, this is probably 2 months ago. So it's even, we've been consolidating for really like probably almost a year and a third now at this point. But generally when this happens, like this normally breaks up. So I think you could get a fake down below maybe 29, but that's definitely not my base case. I do have a little like cash, especially on my personal side, available in case that happens. But yeah, I really think that like this is just a base for higher, and looking at all the geopolitical, macro, and all those factors, like I think we're starting to get some more tailwinds. But so yeah, like you kind of zoom in here. I mean, this is just a giant consolidation pattern, in my opinion, and one that will eventually break up. That's kind of my base case still at the moment. So
what do you think as well about the kind of current, macro backdrop that we have? Obviously a lot different than kind of late 2020, early 2021. And how do you think that kind of ties into Bitcoin? And I guess kind of a side question off of that. This has been something that's kind of like widely disputed on Twitter. How much of the kind of macro uncertainty do you think is priced in? Some people say it's fully priced in. Some people say that it's not even yet priced in. So what do you kind of think about that as well?
Yeah, I'll answer that question first. Then I'll kind of go a little more like my macro thesis. So I actually think personally, a lot of the rate hikes are priced in. I mean, and I think like Bitcoin kind of almost functions as the last fire alarm. As we talked about a little bit about earlier, I think it was almost the day of the high inflation print where it was 6.8 back in early November 8th, maybe. Here that like basically what happened is inflation spiked. People started speculating that the Fed was going to address that because they have two mandates. So they have an employment mandate and then they have an inflation mandate. And then they have in my opinion, they have another mandate that's basically like market stability, making sure the markets are functioning properly. And we can get into that a little bit later, but basically that high inflation print. And then so we sold off pretty heavily, obviously, since then. It's starting to look a lot better now, but I think majority of those rate hikes are actually priced in. You kind of see that on the 2-year chart. So the 2-year bond chart. So pull this up. Like, I mean, this chart is insane. It's basically up, 1,500% in a matter of months. And basically what this is telling you is that like the Fed essentially jawboned themselves or talked them, the market into saying like, okay, here's what we're going to do. They were trying to get the market to do the work for them. So rates already priced in what they talked about on like the shorter end of the curve. So because of that, I think like you've already had a lot of the damage unwind. And so if you're looking at in terms of stocks, so basically like everything is tied to the risk-free rate, which is the bond market. And so everything is kind of set off of that. Real estate prices, stock prices to an extent. So basically what happens is you have something called a discounted cash flow analysis, which takes your risk-free rate, and then you have that tied to an earnings to price ratio, or and then from there, you can assess like what the EP ratio should be, similar to price earnings. It's just flipped on its head. But what that will do is that will allow you to figure out what stocks are evaluated at. And so last year, I think it was Urian from Fidelity was saying that the 10-year rate was 100 basis points below where it should have been. And because of that, price to earning ratio was 6 points above where it should have been, because of that discount cash flow analysis. And from there, it basically, because of the liquidity the Fed was providing, it was basically a Fed-induced bubble to the tune of 25% for equities. And that has since calmed down a little bit. And you would say, well, yeah, we haven't dipped 25%. Well, that's right. But also earnings were up quite a bit last year. So really like we're right in the kind of the fair value range for equities now, in my opinion. So I think actually a lot of that really is priced in at this point. And then, obviously we had the geopolitical stuff pop up recently too, which kind of led to the sell-off for Bitcoin. But do you want me to touch on the macro now? Or
yeah, go for it.
Okay. So back when I started trading, you didn't really need to follow this stuff much at all. But now it's a lot more important, obviously. So let me go through. So a couple of things I'll look at. So like GDP. So right now, one of the problems is like the economic growth still really isn't even that high. I think the Atlanta Fed estimate came in at like basically 0. And so like looking at that, we kind of have a problem because the federal debt GDP ratio is now 122 or 123%. And that was after, I think, nominal GDP growth of 10% last year and also 7% inflation. And they were still only be able to get the debt GDP ratio down from 135 to 122. And then realistically, it's like to normalize policy, this needs to get back to 70, 80%. I'm sure you've heard like Luke Groman talk about this before, but so I'm a pretty big believer that, we've kind of hit the event horizon in terms of debt versus GDP. Hirschman Capital did a report that basically said when this happens, 49, I think it was 49 out of 50 or 50 out of 51 nations basically defaulted implicitly or explicitly. So an explicit default would basically say like, oh, bondholders, sorry, you're not going to get your return back. And then an implicit default would basically be where they have inflation or hyperinflation and everyone gets paid back nominally, but not in real terms. They lose a ton in real terms. So I look at that, and then so also, well, this is like the yield curve 10 minus 2. So people keep talking about, the Fed's going to hike, and they just, they say it over and over. And I think a lot of trade fight people miss is like the fiscal problem the United States is under. And I'll kind of go into that a little bit. Let me see if we can find these charts. Let's see. That's PMI. Here, let me get rid of these stuff. Okay. So we have your financial index. You have the, oh yeah. So this is where I want to get to. This chart basically shows the real yield. You can see like it's at negative 5.7 now, which this is basically financial repression, meaning if you hold cash or bonds, you're getting completely like basically money stolen from you essentially. and it hasn't been this low since like the 70s. And if you remember in the 70s, well, I wasn't around, but gold did extremely well in that decade, hard asset. And so also this chart doesn't show it, but it was pretty bad in the 40s after the war as well. And so I'm kind of using the 40s as an analog for what needs to happen now. Basically, the government needs to have cap yields, and then they need to have inflation to be able to lower your debt to GDP ratio so you can normalize policy. Otherwise, you run the risk of having a debt spiral, or basically like you can't have enough growth to outrun your debt, and then you basically need to have your the Fed or the central bank monetize everything. So basically, they're the only ones that are buying like the government's debt and the bonds, and that's kind of like the end game there. So that's the problem when that happens. And also, let's see. So one of the things I look at too, right now, our federal surplus or deficit as a percent of GDP is basically as low as it was, almost as low as it was in the 40s. This basically means is like you're not getting enough economic activity to for the debt that you're basically trying to use debt to increase the economic activity, but it's not working super well. One of the other things that I look at is, let's see if we can get pop up here. Sorry. All right, this one is what's your M2, but then I have yeah, this is what's showing your total public debt divided by your foreign holders. So what before, you can see right here on the chart that this gap is getting larger and larger over time. So basically what that's saying is you're domestically or internationally, you're not having enough people that are interested in buying United States government debt. So what's having to happen is the Fed is basically increasing their balance sheet to pick up the slack. And this is basically that chart that I just showed, but it's having the foreign buyers divided by the total debt issued. And when this is turning down, you can see in 2014, this is when like Russia and China stopped buying treasuries. And this has been going in downtrend now for a while. And what this is showing is that the Fed's going to have to keep continuing to buy in all the government's debt. So why is that a problem? Well, people say, you know, they can raise rates. There's not going to be an issue with raising rates, and you know, just take some of the steam out of the economy. Who cares if the stock market goes down 20% or 30%? Well, the problem is almost all of our GDP is tied to the wealth effect, and so what that means is personal consumption. So basic consumerism is 70% of our GDP, and we basically buy everything else that the world makes. A lot of it comes from China. You know, we buy some of Russia's oil and so on, but that's basically saying if you have a drop in stocks, and you already kind of see this in the chart where it's starting to roll over a little bit, but you're not going to be able to have this sustained GDP growth that you need if stocks are down. And this also kind of shows like your tax receipts over GDP. And you know, if this starts rolling over, that's not good, because you're not going to have as much tax receipts, because tax receipts is tied to the wealth effect. And if you have less tax receipts, you're basically not able, you need to print more T-bills and issue more debt to be able to finance the government spending. And you also have, I think it's the boomers have 100 trillion of unfunded liabilities coming in soon. So basically, I'm of the thought process that the Fed is going to hike maybe 1 or 2 times to try to keep some credibility. But realistically, like, the work has been done that they needed to do. And I think they're going to keep rates pretty low. I don't think they can raise them, really. I mean, basically their debt's too high to where if they raise them, like, it's just stuff's going to start breaking. So
I guess kind of as like a counterpoint to this was, you know, I kind of stand in the camp of what you're saying, but my buddy Pentoshi, I'm sure you've probably seen Pentoshi on Twitter. His thesis is kind of that the Fed is willing to trigger a recession, and that, you know, they basically have, you know, they have to choose between one of two bad options,
Yeah.
excuse me. One of them obviously being like inflation running hot, and the other, equities, and just assets in general, going into some type of, prolonged recession. So his kind of thesis is that the Fed is willing to take on some type of recession similar to like Volcker, because, at least if they choose that option of the two, they're still able to kind of maintain control of the system. I'm curious, like what would be kind of your response to someone who had a thesis of that kind of regard?
So, I don't think that thesis is like crazy or anything, because I think the people that have that thesis, a lot of them look at what the Fed's mandates actually are, which are inflation and unemployment. And unemployment's doing very well right now, and then the very low rates, and then but inflation's obviously high. So people just say, oh, well, that's one of their two mandates, so that's what the Fed is going to focus on, and it's unacceptable to have an inflation rate. But my response back to that would basically be the Fed needs inflation. The US government needs inflation, and they need rates low to inflate their debt away. Otherwise, it's not going to matter, because you're basically going to have, like I said, a debt spiral, and then you're not going to be able, you're not going to be able to finance this stuff. So, and also if you create a recession, then it goes back to like the tax receipts, and then how much the wealth effect, and like the GDP going down. I already showed you the chart of, the Atlanta Fed and how that was, estimated zero. I mean, if you're having zero GDP growth, like, and your debt, even if your coupon on your debt is going up 1% or 2% of what it is now, that's just unsustainable, because you're basically having that GDP grow without doing anything. So I don't know. I get the argument. I think people, but they just don't realize how bad the fiscal situation is, and that's kind of, I guess, my response to that, and why I think the way I do.
Okay, that makes sense.
Yeah.
So like to kind of pivot off of macro, what do you think about Bitcoin long term, given kind of the macro backdrop and where that's kind of pointing in the next 5-10 years, and like kind of longer term, given that a lot of these things that you just had pointed to are kind of not sustainable? And why do you think Bitcoin, well, this is something we talked about privately yesterday, why do you think Bitcoin will kind of remain to be the main store value, not only in the crypto space, but as well, why is Bitcoin kind of the superior store value compared to other assets, just in broader markets as well?
Yeah. So let me bring a couple charts here. One moment. So this one is, let's see, this one, and then one more here. Okay. So I'll try to address the, I guess, like store value, where I think it's going. So I told you at the beginning, I kind of had this thesis of, what is Bitcoin's total addressable market, when I started investing, and what could happen? Well, obviously a lot of things can happen. It could go to zero. There could be a hack, the government could attack it, whatever. Like, those are all pretty valid concerns. 2013, I don't think they're nearly as high as the probability. Now I think you have some governments that will attack it, but game theory kind of says that some countries like El Salvador and others will embrace it, and so that you'll have a brain drain there, and also a capital drain to those countries if they don't treat it well. So I was kind of like thinking back a while ago, and I think Crocious BTC put this out, but it's looking at all of the potential ways that Bitcoin can take money away from, basically. So you have the gold market, you have cars, other collectibles, fine art, real estate, stock market, bonds, including negative and low yielding bonds. So basically what that's saying is, you take 40% of gold's market cap, you take 10% of collectibles, 20% of fine art, 20% of real estate, 20% of stock market, 90% of negative yielding bonds, and 50% of low yielding bonds. Well, that gives you 206 trillion, potentially Bitcoin's market cap there. And this is not right away. This is something like that's over a period of 10, 20 years, right? But I think honestly, right now, the biggest driver is going to be bonds. I think people that are looking at people as digital gold are thinking too small, because think about it this way. It's only going to get worse. So inflation's, I think, going to continue off and on high for this decade because they need to get the debt GDP ratio down. So assuming that yields are going to be capped and inflation is going to be high, well, bondholders are probably going to lose 50% at least of their value if they just stay in bonds. And I think people are going to start to figure it out, especially if you get some like negative 10% real rate in terms of bonds. So I think a lot of that capital will flow into another different store of asset. And if you see Bitcoin rising all while your bonds are falling, it's like, it's kind of almost like a human nature to chase something that is rising. So this is kind of how I view my long term. You've seen from ARK also put out a pretty good one. So this is a little bit different, but it basically says like remittances, the M2 settlement network. So basically like the reserve asset, nation state treasuries, Caesar resistant asset, which is super big now, institutional asset and corporate treasury, and then digital gold. Like he comes to it in price of 136 or 1.36 million per BTC. I think the other one I looked at, that was roughly like 10 million per BTC. But so I don't know. I really am pretty bullish. I think this thing is going to take over the world. And that's kind of the hard thing is like when I'm so bullish long term, but I have to like try to make more Bitcoin, try to trade Bitcoin and do all these things. Like that's one of the things that I struggle with a little bit because I always definitely had the long term in mind, but I have to separate that from my trading. So, and then let me talk about.
I personally agree with that as well. That's something that I think is, if I had to like be self-critical of myself, it's definitely that like it's tough to kind of zoom in and out and maintain that really long-term bullish thesis and then still maintain complete objectivity in kind of the short to intermediate term for sure.
Yeah, it is. And that's one of the things, like you always have to have a little bit of bullish bias, but also like know where you are in the cycle too. Like, I mean, and that's where it kind of comes down to the value. If you're, 2.4 times your 200-day moving average, well, that's pretty good value to sell. I mean, everything kind of has an adoption curve. I mean, so basically I look at, with the hard cap supply and you have that total addressable market that you can pick from, but you kind of have that, but you also have the demand aspect. So that's kind of like a little bit of the supply, like people are going to hold on to that, their Bitcoin, but then you have the demand aspect, which is essentially like the Metcalfe's law, and then all the adoption curves, S curves, and so on. And so like, that's kind of two different ways to look at it, but you kind of end up on the same conclusion. And let me share a couple of charts in regards to that. So Tim Peterson, he basically has done some valuations, basically based upon Metcalfe's law, and he has this like lowest price forward, based on those metrics that in this adoption curve that he's put together. And his long-term targets are, let's see, basically end of the year in 2033, so roughly 11 years, 12 years. His target was 8 million per Bitcoin. So that is this, and this is a demand-driven model. It has nothing to really do with supply. So this is a completely different way to end up with, looking for a valuation metric. And then you have recently Urian from Fidelity. So he put this out recently, whereas Bitcoin demand models, this is based on S curves. So he took essentially the number of address accounts, and then like the growth model for mobile phones, and then growth model for internet users. And what this is showing is that like by the time you get like 2033 on the high end, he has roughly like 4 or 5 million per Bitcoin, and on the low end, 2035, it's like 1 million. So to me, like this is a completely new asset class. It's important. It makes sense demographically to millennials and Zoomers. You're what, 20 years old? I think, I think you probably, when did you get a cell phone? Like 10? You're on mute, man.
My bad. Yeah, I was
You're
I
good.
was in I was in fifth grade. So yeah, I think I was like 10 or
Yeah,
11.
see, I didn't get a cell phone. I didn't get a cell phone until I turned 18. Like basically, I was leaving for college. So you guys grew up with phones. You know, your generation. Like I'm a millennial. Like it's a little bit different. But think about like boomers don't understand this stuff. I mean, some get it obviously, but like as a whole, like it doesn't make sense. They live in an analog world. We live in a digital world. You know, you probably spend most of your time online. Like a lot of people are like that, just with like social networks and also like internet and everything. So Bitcoin just makes sense from that perspective, like a demographics perspective, to where you're going to get this growth. And I don't know, it's hard for me barring like honestly the only thing I could see it stopping it at this point is just like a catastrophic bug in the code. So because even with nation states, like say the United States like ban it, which I don't think is high on the list, but say that they're banning it. Well, I talked about that game theory. I mean, people in the United States are just going to leave with their Bitcoin and go to El Salvador, go to somewhere that embraces it, you know. And um, so that's kind of like, I guess, my base case is that that's not really even that big of a concern at this point. So,
No, that makes a lot of sense. So two more topics before we wrap up. The first one is what is
sorry,
your
can I?
Oh yeah,
Sorry.
yeah, yeah,
Oh,
yeah. Sorry, I thought you were finished.
no,
Go ahead.
you're good, man. I was just going to try to hit on the topic of the like why I think Bitcoin wins in terms of like decentralization or
Yeah, for sure.
versus
Go
other
for it.
alts. Can I touch on that? Sorry to interrupt.
No, totally. Go for it.
So you see what's happening across the world now, basically, right? Where you have governments in Canada, you know, basically trying to lock people's bank accounts because they're donating to a protest that the government disagrees with, right? And then you also have now where you have, you know, Russia's central bank had their assets, their FX reserves frozen because, you know, well, this is a little bit more understandable because they, you know, invaded Ukraine. But still, what that's saying, this affects tons of Russian citizens that don't even agree with the war too, you know. And so long term, you need something that is completely decentralized, something that can't be taken, somewhere you can move borders without, you know, being frictionless. You know, they're not going to can't take your keys away if you have it memorized in your head. They can take your gold bars away if you try to get through an airport, you know, to flee, or your cash, or can't take your real estate with you, can't take your stocks, can't take your bonds, you know, if you're fleeing, but you can take Bitcoin. So that's why I'm like a huge proponent of centralization. And ultimately, like I really like some of the things the other networks are doing, like Ethereum, Solana, like some of those things, you know. But I think the most important thing of this decade is still going to be we need to fix the money and we need decentralization, because you're seeing, you know, governments like Australia, governments like all over the world, Canada, that are being super heavy-handed, and they're just trying to take, you know, people's money. I mean, your money is not safe in a bank. I mean, even with fractional reserve, you know, it's what they might have 2%, 5% reserves on hand. So if you have people trying to get money at the same time, like in Russia, that's just gone. You know, it's literally not your money. So I think decentralization is super important. But you kind of had like this whole talk recently that's a hot topic with Ethereum versus Bitcoin. And you know, like I said, I think the smart contracts and stuff like by Talk did a lot of great things. I think Ethereum is really cool, but why I prefer Bitcoin over Ethereum is mainly decentralization and the proof of work. So recently, Ethereum trying to kind of pivot to hard money to basically rival Bitcoin in that regards. But the problem is with their smart contracts and all their lending and borrowing, you need fees to be low for that to be able to have utility. So they're trying to really like ride two horses with one ass, because they're going after the hard cap money and saying like, oh well, our issuance rate is lower than Bitcoin's, but at the same time, you know, they changed that. Like if it's not immutable, they changed the code or whatever to be able to have a lower issuance rate. And there's nothing that says that they can't do it on the other end either. And also, I mean, Bitcoin, to be able to make a changes, you have to go through the nodes. It's super easy to run a node with Bitcoin because it's really cheap. I think you can do it for $100, whereas like Ethereum, you almost need, I think it's like 1,000 gigabytes. I'm not 100% sure, probably more than that actually, but it's a lot harder to run a node. So that makes it more centralized. They're trying to move to proof of stake, which then you have the whole, debate with validators basically being more, like the concentration of wealth, like how that's similar to our current status, where basically like if Jeff Bezos has, wants to influence politics, well, he has a ton of money and lobbying power to go to Congress and say, hey, I don't want to pay taxes in this state. Like, help me out. I'll scratch your back. You scratch mine. And that can happen with POS too. That's one of the concerns I have. So I do think that those are good contracts, but good chains. But I kind of don't like the fact that they try to go after Bitcoin's like hard money aspect, because I don't think they will ever be that. I think they should just focus on, try and be the best, most utility going forward, and fix their, their fees, because that's why Ethereum is losing some people to the other layer ones. So.
Yeah, no, that makes a lot of sense, and I definitely agree with you. What do you think about the correlation to TradFi and just like broader legacy assets, both kind of in the short term and then in the longer term as we move out, call it 5-10 years or whatever from now?
So this kind of comes down to the chart here I have up is basically the VIX, so the volatility index. So you've probably heard some people throw like the terms around like long vol or short vol. And right now, so basically if you're a long vol asset, you would expect that to go up when the VIX spikes. So if you kind of see the chart here, whenever the VIX is spiking, Bitcoin has been going down, which essentially means that it is a short vol asset. But the problem is that I see is that over time, Bitcoin is going to, if you miss the top 10%, top 10 days, you go from 147% compound annual growth rate to 91%. If you take out the top 20, you go down to 61%. If you take out the top 30, you go down to 39%. If you take out the top 40, it's 21%, and the top 50 is 7%. So Bitcoin trades like a risk asset and moves with the asset in terms of when there's high VIX numbers and also when there's sideways. But the problem is, just like we saw the other day, Bitcoin went up 15% when the NASDAQ and I think the SPX were down. Like if they were truly correlated, then you wouldn't have had that gain. And so that's the thing, is like, if you're looking at it from that construct, then you're going to miss out on a lot of the gains. So I don't know, it kind of is and it isn't. And I think long term, it's going to turn into more of a long vol asset like gold, but I just don't think it's going to be a transition. Recently, I think you also have a lot of, like, ever since Wall Street started coming in more, they basically treat it as a short vol asset. And so they do a lot of like, they treat it as a high beta, meaning like high beta basically means like if you're looking at the SPX, and SPX goes up 2%, well, Bitcoin as a high beta would go up, say 5% on that day. So what they end up doing, I think, is, and what's being done recently is that, like, when you have the VIX spiking and they expect stocks to go down, you have people on trading desks that might be shorting on the CME or something, so that's helping to send Bitcoin down. But all those people that are essentially naked shorting, they're going to have to buy back eventually. So because of that, I think we could potentially have a short squeeze moving forward. But
that makes a lot of sense. I think like people that are bidding on that correlation lasting forever, at some point are going to kind of get blown out of the water, as we saw with that massive move the other day. Last topic kind of for the day is, what are your thoughts on the halving, especially moving forward? Are you kind of in this camp that a 4-year cycle forever? Do you think we've already kind of broken out of that pattern? And I guess just what are your broader thoughts on the 4-year cycles moving forward?
So I wrote a huge thread probably on Twitter. I think it was like right before the halving, and I basically said like, this is definitely not priced in. There's going to be a supply shock because there's lower issuance, and that's if we have the same demand, then price is going to go up, and then basically it's like this feedback loop where price goes up, people pile in, and so on. It kind of, and so that's happened almost every cycle so far. But I do think that's starting to come to an end, mainly because a couple of reasons. One, the issuance is lower. So there's 900 Bitcoin a day now. And then I think in 2 years, roughly, that's going to go down to 450, which is not really that many, to be honest. And then the other aspect is a lot of miners now are way better capitalized. So they can get fiat loans, say in USD, and then they basically can hold all the Bitcoin they mine on their balance sheet. And that's what you're seeing with like Riot and Marathon and some of these other big miners that you didn't have that last time. So, and you also, so because that dynamic, but then you also have all these other dynamics too. Like, for example, like all the derivative exchanges, like they have fees that they make, which basically are a lot of times are just sold on the market. And so it's almost like if you have a chop zone and then they make all this money on fees and traders getting blown up, well, that's going to need to be sold. You have the GBTC fee, and that's like some a little bit of a drag on overall. So you have some of these other mechanisms that are starting to weigh a little bit more into. So I generally think if I had to say that the 4-year cycle is done, I do think the halving will give Bitcoin a little boost in 2024. But as time goes on, it's going to matter. The halving is going to matter less and less.
Yeah, no, I completely agree with that, especially all the kind of dynamics you talked about, and how the kind of primary sell pressure is evolving over time, and will continue to do so.
Hey, would you mind me touching on one more thing?
Yeah, go for it, man. I was about to ask you if there's anything you wanted to touch on before we wrap.
Yeah, I kind of wanted to like maybe end with like the incentives and why I think like Bitcoin mining is so important. And this is kind of important to me, like as a former engineer. I think it's like it gets me excited about the future and stuff. And I talked to my dad a lot because he works at a utility, and they were actually mining Bitcoin for a bit. But I kind of want to talk about Bitcoin's like incentives and what's going to drive adoption in the future. So to me, you have 4 things. You have remittances, which is essentially what's going on with El Salvador and the Lightning Network. So, Jack Mallers has been working on that. He has shown that you can send money. You don't have to rely on these rent-seeking companies like Western Union. So basically, instead of paying a 30% fee, you can pay a 0% fee, and basically all that money is going to be pushed into the economy that wouldn't be there before. It's not in the pockets of Western Union. So that's a big one. That's going to be worldwide, especially in developing countries. Another one is going to be the censorship resistance of money. So that kind of ties into like the Canada stuff that we just talked about. So you want to have money out of the kind of like the purview of the government. They're not going to be able to take your money if you have your private keys. That's why it's also important to get your Bitcoin and Ethereum or whatever off exchanges. The other one is going to be your hard cap. So I think people that are of the gold bug thesis, the immutable hard cap, that's important. And then what was the last one? So man, I can't think of the last one I was going to say. Anyway, oh yeah. So I remember mining. So this is probably one of my favorite things. Like, so you kind of have this big thing with ESG, right? So ESG is this big push lately that's trying to say be more environmentally conscious, social governance. So how does that affect mining? So a lot of people said proof of work is bad for the environment, or, because Bitcoin's using energy, it's not important. Well, two things I have a bone to pick with that is, one, value is subjective. So, Christmas lights use more energy than Bitcoin. I'm pretty sure dryers do. Everybody enjoys those things. This is for censorship, sovereign, individual sovereignty, resistant money. It is important, so anybody that says that, like, that would be my response back to them. But even looking into the numbers, I think the very important thing is that Bitcoin mining will be integrated with every single utility and every single gas company going forward. So what are the reasons for that? So right now, when you look at, say, a utility, what is it? So they have power plants, or they have windmills or solar or whatever. Like, they're basically producing power, and they're the seller of the power. They need a customer. So the customer is people that live in that residence or that jurisdiction. So what happens is, say you have a nuclear power plant that has to run, and then say that the jurisdiction uses 100 megawatts of power per day, but then you have all these power plants that are making, say, 120. Well, these power plants, like nuclear, can't shut off at night. So what's going to happen is you basically have to waste that power at night, and you don't have a user that wants it. So what's going to happen is you're going to have all these miners at these power plants. They will be the buyers of last resort for that energy. So they will come in, they will buy that energy at nighttime when there's a low need for power. And then also, it's interesting because you can green up the grid basically by having additional solar and wind and overbuilding the grid, basically. And then what will happen is you'll have your base load, but you'll also have all these wind and solar. And so if let's just say that you have all this overbuilt, so normally you can use these wind and solar when the wind is blowing, when the sun is shining. But eventually what will happen is you won't need that at times. And then, but you don't want to waste that. You just don't want to have these extra power plants. You don't want to have these extra windmills that no one's going to use. So you need to have a buyer for that power. So Bitcoin miners will be attached to that. And so you'll be able to overbuild eventually. And then you always have a buyer of last resort. So that will allow us to get greener in terms of the power load. And I think that's like definitely something that people really aren't thinking about, because people say Bitcoin needs to use less energy. I think it needs to use more energy in that regard.
Yeah, I think that's a great point. And as well, just something you kind of alluded to, like, I think we need to kind of get off the defensive about kind of justifying Bitcoin's energy usage, and instead just kind of talking about why it does use energy. Like, if you explained the kind of financial freedom that it's providing and banking people in areas that their currency is devaluing rapidly around the world, I think people don't understand, especially privileged folks in the United States don't really understand the purpose of what that energy is providing for people. And then as well, I think, as you touched on, there's certain things like the Christmas lights one's always a good go-to about, the comparison of energy usage. I think like the reason that, it gets so much light shed on it is just the fact that Bitcoin is so transparent, right? And compared to many things, like there's no ledger for you to, look at how much energy is being used at any time by Christmas lights, but you can with Bitcoin. And so due to that nature, I think, people would be surprised if they did know that the, energy output of many commonly used things, but because Bitcoin is so transparent, it gets so much light shed on it.
No, I mean, I totally agree with that. Yeah, it's a very interesting debate. I think it's like we're just so new with it, because this is one of those things, like when I started investing in Bitcoin, like I had no idea about mining. Like I was like, oh, mining, like that's kind of interesting, but I didn't really see how it would tie in with the energy sector. Marty Ben always says, like, it's game over because, Bitcoin's already won because it's won the energy market, and I kind of agree with that. And I think a lot more people kind of start to figure that out, along with the kind of like censorship resistance and so on. And I think that, governments might attack, some cryptos, and especially some like the DeFi platforms, because that is like a direct infringement upon like banks and, like their rent sinking behavior. So I mean, you saw it with BlockFi, they have $100 million fine recently. And I think that's because they don't like the fact that you can go get 10% on your money using a stable coin, when before in your bank account, you're getting like 0.1%. And there's a reason Jamie Dimon spends 65 days a year in DC lobbying, it's it's to keep crypto stuff out, like it's to keep this stuff out. But the thing is, like, this is going to happen regardless, and we're going to win overall. So I don't know. I'm excited about the future though.
Yeah, I love that. And with that, I think that's a really good way to kind of segue to wrapping it up here. Before we do, I want to kind of give you the floor to get any final thoughts that maybe you have, and then as well kind of plug in anything if you did want to plug in yourself, maybe your Twitter fund or whatever you want to plug in here.
Yeah. So yeah, fund is just Sats Cap. So my Twitter is, here, I'll pull it up. But also it's at BTC Fiend. So here. So at BTC FEEN, and yeah, so fund Sats Cap, and then I don't know, yeah, just go follow me, and then if you want to follow my buddy Trey, let me see, get him up. He's my partner, so he's at Trey Stewart 14. So yeah, I guess that's really all I had to say. I mean, I think I'll kind of leave with I think we're facing we're at the they fight you part now, and like Bitcoin has become big enough. And I think in regards to like the geopolitics, I mean, we didn't touch on this a lot, but I think you're starting to see cracks in the dollar system. I think that's becoming evident. Russia and China don't really like the dollar system because it doesn't benefit them. I think you're going to have like, some stuff that's coming out of that that's really interesting. I won't go into too much detail, but basically, essentially, like, especially Europe is super reliant on Russia for energy, and they I don't know, they know that the West is very indebted. So it's going to be an interesting month and interesting couple of years, and really the decade, I think. So but yeah, I would just tell people, like, just think about like what's going to matter, in the next decade. And is like DeFi going to be more important, or is like censorship resistant money? I mean, it's all important, but kind of figure out like what makes sense, and look where governments might come after things, and where you need to stay safe. So
Steve, thank you so much for coming on the show, man. We'll have to get you on maybe next quarter. I could talk to you for 3-4 hours, but you really appreciate you coming on, and I'll talk soon, man.
Yeah, thank you, man. I really appreciate it. All right, take it easy.